Well, I think, as I set out in my notes, that we will see equity markets forming yet another base before we get a rally towards year end and into the first half of next year. Having said that, if we just look at the last few days, I think it's very clear that markets have got ahead of themselves. And as you correctly mentioned, there was a discounting that there would be very good progress on the vaccines. And as we all know, that's going to be very much a stop-start process. I think there's a high probability that we will get a successful vaccine, but sometime in the first half of 2021. And there isn't much evidence of immediate success on a vaccine. On the question of the fiscal stimulus, you've had a lot of very strong statements from not just the IMF, but also from Jerome Powell, saying that the US needs badly a second fiscal stimulus. And at the moment, we have this sort of argument about whether the fiscal stimulus should be over $2 trillion US, which is what the Democrats have proposed, whether it should be under 2 trillion, and with the Senate Republicans looking at a figure sort of well below 2 trillion. So progress seems to have stalled, and obviously there is still the distraction of the appointment to the Supreme Court. So it's very difficult to actually say with any confidence that we will get a second stimulus package over the coming weeks. My own view is we probably get a rather unsatisfactory stimulus package somewhere between 1.5 and 1.8 trillion, but that's not the sort of size that can propel this market further.
Mr. Parker, good morning to you, sir. Here's the FT comment from yesterday. Investors queued up to buy Italy's new 3-year bond on Tuesday, even though they will get nothing back until 2024. It has a zero interest rate on this as well. Surely the only place to hide is equities.
Well, one of the reasons why equity markets, I think, will have another leg up towards year end and in the first quarter of next year is that if you have to look at the alternatives, and we're in a situation where government bond yields worldwide, and most notably in Europe, are at or near historic lows. Let's not forget that 10-year bunds at the moment are sort of trading between minus 55 and minus 60 basis points. Spreads in Europe are historically tight. You've got Greece trading, 10-year Greece trading at close to 80 basis points. And you refer to Italy. The spread between 10-year Italy and 10-year bunds, is now down at about 120 basis points. So, it's difficult to say that there is any value in government bond markets, and most notably in European bond markets, and that in turn is going to push investors into equity markets.